Welcome to the deep dive. Today, forget the roller coaster of trying to, pick the next big breakout stock.
Yeah, let's skip that stress.
We're sinking our teeth into a different kind of strategy. It's less about those quick, fleeting gains and more about, sustainable wealth.
Building something solid.
Exactly. We're calling them income trees. Think of assets, things that consistently produce income for you, like picking fruit year after year.
Without having to sell the whole orchard. That's the key difference.
So our mission today in this deep dive.
It's really to show you how carefully, thoughtfully, cultivating a portfolio of these reliable income-generating assets can be the foundation.
The bedrock for long-term financial security.
Absolutely. We've looked through the sources to understand the different kinds of these income trees out there, and maybe more importantly, how you can spot the ones that will actually thrive.
Okay, let's get down to this core idea then. Planting seeds for the long haul. This source material uses this really simple but honestly quite powerful image. The poor person who consumes everything versus the wealthier one who invests.
Invests in assets that keep giving back. It really does make you think, doesn't it?
It does. This whole idea of the income tree. Something providing ongoing returns without constantly having to trade or sell.
Compared to just chasing that unpredictable price appreciation.
Right. And think about the downsides of relying only on capital gains. You have to sell to realize the profit.
And that brings up all sorts of headaches. Is now the right time? What about market timing? Taxes.
Oh, definitely taxes.
It's a different dynamic entirely with income-generating assets. You get this regular stream of cash flow.
Cash flow you can potentially reinvest or, use. You're not constantly second-guessing that exit strategy.
Exactly. You're getting that income. And it's interesting, the sources point out this is often the path for building lasting wealth.
Owning things like real estate, dividend stocks.
Private businesses, royalties, even big infrastructure projects.
These are all examples of those income trees that have been nurtured over time.
Which naturally leads us to the really critical question.
How do you tell the good trees from the weak ones?
Exactly. How do we distinguish a healthy tree that's going to bear fruit for years from one that looks good initially, but ultimately disappoints?
Okay.
Our sources highlight 4 key things to look for. 4 characteristics.
Let's get into those. These sound crucial. First up is sustainable yield. Now, a really high yield number, that can definitely grab your attention, right?
Absolutely. It's tempting.
But the sources warn us, look deeper than just that number. It's about the quality, the reliability.
Precisely. A truly sustainable yield has to be rooted in the actual financial health of whatever asset is generating it.
Not just smoke and mirrors.
No, not fueled by excessive debt or, accounting tricks.
Yeah.
It needs to be backed by real cash flow. And the sources give some helpful specific benchmarks here.
Oh, good. Like,
For real estate investment trusts, REITs, you want to look for payout ratios generally below 80% of their AFFO.
AFFO. Right. Adjusted funds from operations. That's the key cash flow metric for them.
Exactly. It shows the cash actually available. Then for regular dividend-paying stocks, a payout ratio under 60% of earnings is a good rule of thumb.
Okay, under 60%.
And for BDCs, business development companies, you want to see that the dividend is comfortably covered by their net investment income.
Those metrics give you a much better handle on whether that yield is likely to stick around.
They really do. It's about sustainability.
Okay, that's incredibly useful. The second characteristic, a durable moat. I like that analogy.
Yeah, it paints a picture, doesn't it? A strong defense around your investment.
So in this context, what does that moat actually look like for an income tree?
It's about a significant competitive advantage, something that protects the asset, its profitability, and therefore its income stream, from competitors just coming in and undercutting it.
Makes sense. Examples.
The sources give some solid ones. For real estate, think long-term leases with really stable tenants.
Okay, locked-in income.
For royalty trusts, maybe strong patents or intellectual property.
Right.
For infrastructure, things like government contracts can be a moat.
Right. Exclusive rights.
And for consumer brands, think about powerful brand loyalty. That's a huge advantage.
So things that make the income stream more resilient, harder to disrupt.
Exactly. Something with staying power.
Okay. Third characteristic, predictable cash flow. This seems pretty straightforward. You want that consistent harvest.
You do. Predictable cash flow gives you more certainty for planning, and it reduces the ups and downs in your income.
Less volatility.
Right. The sources point to certain business models that tend to have this. Subscription services are a big one.
Like software or streaming. recurring payments.
Essential utility companies, often in regulated markets. Businesses with long-term contracts.
Or things where demand is just always there, like waste management or telecom.
Precisely. Sectors with consistent ongoing demand.
Got it. And the fourth crucial characteristic is inflation protection. Feels very relevant right now.
Extremely relevant. How do these income trees hold up when costs are rising everywhere?
Yeah. Does your income keep pace?
Well, some assets offer inherent protection. Tangible assets, like real estate and infrastructure, often see their value and income potential rise with inflation.
Makes sense. Hard assets.
Companies with strong pricing power, too. Think iconic brands like Coca-Cola or Procter & Gamble that can usually pass increased costs on to consumers.
They can raise prices without losing too many customers?
And then there are specific investments designed for this, like TPS, Treasury, inflation-protected securities, and other inflation-linked bonds.
Okay, so that's the checklist. Sustainable yield, durable moat, predictable cash flow, and inflation protection.
That's your framework for finding quality income trees.
All right, now let's explore the orchard itself. The different types of assets the sources mention. First, dividend growth stocks. The sources call these the apple trees.
Yes, a nice analogy. These are companies that don't just pay a dividend, they have a history of increasing it over time.
Growing the payout.
Exactly. The sources suggest looking for companies with, say, at least 10 straight years of dividend hikes as a good starting point.
Any familiar names mentioned?
Yeah, they give examples like Johnson & Johnson, PepsiCo, McDonald's, Lowe's. Big established companies often fit this mold.
The key isn't just the yield now, but that potential for growth in the yield itself.
That's the crucial insight. You're potentially getting more fruit each year, as you said.
Plus, if you reinvest those growing dividends...
That's where the real power of compounding kicks in over the long term. Massive potential.
Okay, apple trees. Next in the orchard. REITs, real estate investment trusts. The palm trees.
Right. Remember, REITs own and operate income-producing real estate, and they have to distribute a big chunk of their taxable income as dividends. It's legally required.
And there are different flavors of REITs, right? Focusing on different property types.
Absolutely. The sources mention several. Residential REITs, like Avalon Bay, owning apartments.
Oh.
Industrial REITs, like Prologis, with warehouses. Very important for logistics now.
Yeah, e-commerce driven.
Retail REITs, like Realty Income, they famously call themselves the monthly dividend company.
Ah, monthly income. That's appealing.
And healthcare REITs, like Ventus, focused on medical facilities, senior housing, lots of variety.
And that potential for monthly income from many REITs is definitely attractive for cash flow planning.
It can be. Though it's worth noting, different REIT sectors react differently to economic shifts, especially interest rates. Something to keep in mind.
Good point. Moving on, we have utilities and infrastructure. The sturdy oak trees.
Aptly named, these are often your essential service providers. Think electricity, water, gas. They often operate in regulated environments.
Which can lead to more stable, predictable returns.
Generally, yes. Utility companies like Dominion Energy or NextEra are good examples. Infrastructure too, toll roads, airports, power grids.
Things we all need, basically.
And often with high barriers to entry, which helps protect their cash flow.
Okay. Then there are master limited partnerships, MLPs, and royalty trusts, described as the crop fields, known for potentially higher yields.
That's the main draw, yes. MLPs, often in the energy sector, think pipelines like Enterprise Products Partners and Oil and Gas Royalty Trust, can offer yields in the, say, 6% to 10% range, sometimes even higher.
That sounds great, but there's a catch.
There's always a catch, isn't there? The big one here, as the sources strongly emphasize, is taxes. These often issue as Schedule K-1, not the usual 1099 DIV form for dividends.
Which means more complicated tax filing.
Definitely adds complexity. You absolutely need to understand the tax implications before diving into these.
Crucial warning. Okay, lastly, business development companies, or BDCs, the nurseries.
Clever name. BDCs essentially lend money, provide financing, mostly to small and mid-sized private businesses.
And then they pass the interest they earn on to shareholders as dividends.
That's the model. The sources mention some top players like Main Street Capital, Main Tanny, Ares Capital, ARCC, Hercules Capital, HTGC.
They're described as kind of like mini private equity funds.
In a way, yes, offering access to lending to smaller companies, which can generate those high yields. But remember, their performance is tied directly to the health of those smaller businesses they lend to. So there's a different risk profile there.
Right. Depends on the underlying borrowers. Okay, so we've surveyed the different types of trees. Now, the practical side. How do you actually plant your own income forest? What are the steps?
The sources lay out a pretty helpful four-step approach. First, design the layout.
Meaning diversification.
Exactly.
Right.
It underscores the importance of not putting all your eggs in one basket or all your seeds in one type of soil, maybe.
Nice.
You wouldn't want an orchard with just one kind of fruit, right? Different trees thrive in different conditions. Same idea here.
So mix it up.
Yeah. The sources suggest thinking in layers. Maybe a core of stable stuff, dividend growers, utilities. Then a layer for more growth, potential REITs, BDCs, maybe some MLPs. Perhaps even a smaller slice for more speculative income plays.
Diversifying across asset types, yield levels, how they react to the economy.
That's key for building resilience. How might different trees do in a recession versus high inflation? Balance the orchard.
Makes perfect sense. Don't rely on just one income source.
Right.
Step 2 involves taxes, using tax advantage accounts strategically.
Right. Since income from REITs and BDCs is often taxed as ordinary income, which can be a higher rate,
it might make sense to hold those in accounts like a Roth or traditional IRA.
the sources strongly advise considering that, to potentially shield that income from immediate tax.
Whereas dividend growth stocks, if they pay qualified dividends,
Those often get taxed at lower rates, so they might be a better fit for a regular taxable brokerage account. Tax location matters.
smart planning. Okay, step 3, reinvest, especially early on. This is the compounding magic, right?
This is where the snowball really starts rolling downhill, especially when you're building your forest. Reinvest those dividends.
Use DRIPs, dividend reinvestment plans.
Exactly. Many companies offer them, or you can set up automatic reinvestment through your broker. You buy more shares with the dividends,
Which then generate more dividends.
and it just builds and builds over time. The sources have a great line, don't eat the fruit, plant the seeds.
I love that. Okay, final step. Monitor, but don't micromanage. Stay informed, but don't tinker constantly.
That's the balance. You don't want to freak out and sell with every market dip, but you do need to keep an eye on the fundamental health of your trees.
What are the warning signs?
Key things to watch. Dividend cuts are a big red flag, obviously. Negative earnings trends, payout ratios creeping way up, maybe over 100%. That signals the dividend might be unsustainable.
Or big management changes suddenly.
Yeah, sudden, unexplained turnover at the top. Those are things to investigate. But otherwise, let your carefully chosen assets mature.
Good advice. Now, the sources also warn us very importantly about incline tree imitators. Things that look good, but aren't.
This is so critical. Not everything dangling a high yield is healthy or reliable.
Like what should you watch out for?
The sources mention things like some high-yield ETFs that might be juicing their yield numbers artificially, maybe through leverage or options, without a solid base of quality assets.
Okay, unsustainable yields.
They also warn about, some risky crypto yield products promising returns that just sound too good to be true.
If it sounds too good.
It probably is. And leveraged ETFs disguised as income plays, their volatility can wipe you out.
So how do you filter these out?
The sources suggest the grandma's grocery money test.
Explain that.
Basically, ask yourself, would you feel comfortable putting your grandmother's essential grocery money into this investment if it feels too risky for that?
It's probably too risky for the core of your income portfolio.
Exactly. It's a great gut check for risk.
Fantastic rule of thumb. Now, let's connect this to real life, especially retirement. The sources mention the 4% rule.
Yeah, the classic guideline. The traditional 4% rule suggests you can probably withdraw about 4% of your portfolio value each year in retirement and have it last.
But building an income tree portfolio offers an alternative.
A very appealing one. If your portfolio of income trees can generate a yield of 4% or more.
You might not need to sell any shares at all.
Potentially, yes. You could live off the income, the fruit, without cutting down the trees.
Wow.
The sources give a nice example. Imagine a $1 million orchard diversified across different income assets, different yields. They show how it could potentially generate, say, $45,000 a year in income.
Without touching the principal investment, that is the dream for many retirees, isn't it?
It really is. Financial independence in action.
But the sources wisely add, even in retirement, you can't just set it and forget it entirely. Active management still matters.
Absolutely. Even a mature orchard needs tending.
Yeah.
As you get into retirement, the sources suggest maybe shifting gradually towards more stable yield assets.
Like high-quality bonds or those dependable utility stocks.
Exactly. Things with lower volatility, perhaps.
Yeah.
And you absolutely must keep monitoring dividend coverage. Are those payouts still safe?
Makes sense. Anything else for retirees?
You might consider strategies like selling covered calls on some stocks you own. to generate a bit of extra income.
Okay.
And always keep an eye on the bigger picture. Adjust your overall mix based on economic trends, like where interest rates are heading.
So it's ongoing care, even during the harvest years.
Definitely.
Now, beyond the numbers, the sources bring up something called the emotional ROI of income investing. I found this really interesting.
Me too. It's about the non-financial benefits, the peace of mind.
How so?
Knowing you have regular income rolling in, regardless of whether the market is up or down that day, that can be incredibly calming.
You're less likely to check stock prices constantly or panic sell during downturns.
Exactly. When you see your wealth actually working for you, generating cash flow, it changes your perspective. You shift from stressing about speculation to feeling more secure about productive assets providing steady returns.
It's that feeling of building a system that works even while you sleep. Your wealth is productive.
Precisely.
So let's bring this all together. What's the core message for you, our listener, after this deep dive?
I think the fundamental takeaway is this. Every dollar you have that isn't invested in some kind of quality income-generating asset, well, you could see that as a missed opportunity.
A missed chance to build that long-term sustainable wealth, that financial independence.
Yes. The sources pose a really great question. Are you actively planting trees for your future? Or are you mostly just mowing the lawn of your portfolio, hoping for short-term growth that might or might not happen?
That's a powerful way to frame it. Planting trees versus mowing the lawn. And the advice is to start, even small.
Absolutely. Don't feel like you need to redo everything overnight. Start small. Research one dividend growth stock that fits those characteristics we talked about.
Or maybe look into a REIT that owns properties you understand.
Yeah, or learn about dividend reinvestment plans, DRIPs. Just take that first step. The most important thing is getting started.
Because, as the sources remind us so well, the best time to plant an income tree might have been years ago.
But the second best time is right now.
So take that first step. Start exploring how you can grow wealth that lasts by planting your first income tree. Nurture it for a fruitful financial future.
Well said.
Thanks for taking this deep dive with us.